Good afternoon, folks. It's Tuesday, December 21st, 2021. This is the Liberty Call. Hope everyone's having a fantastic day. If it's your first time watching, be sure to like, subscribe, and share. And hope everyone's having a fantastic Tuesday. I just got back from the eye doctor. Everything seems to be in good working order. So my reading glasses prescription is still about the same. So unfortunately, one thing I have noticed is that wearing reading glasses last year is that my up-close vision sucks. It used to be okay. And ever since getting glasses to sit here and read at the desk, it has not helped. But my distance vision is still good, so I can see everything far away. All right. So like I said, hope everyone had a great day. Definitely was a much better day in the market compared to the last few. Market rallied, and then Joe Biden got on the TV and ran his lips for a while. So I don't know what he had to say. I had it muted, and then I had to go take a shower to go get ready for my appointment. So I missed out on what wise words Brandon had to say for us. So, all right. Well, let's go ahead and dive in and take a look and see what's going on in the world of the markets. All right. So the Dow Jones today was up 1.6%. The S&P 500 up 1.78. NASDAQ up 2.4. Small caps are up 2.76. So looking across the broader markets, looks like technologies and small caps did the best today. The VIX was down 8.13%, down to 2101. So that looks like a good number. All right, looking across Europe, I see a lot of green right here, so that is certainly good. A little red for these three markets right here, and then Asia was in the green also for last night into this morning. So, all right, so it looks like across the board, markets look pretty decent. As far as everything else in the world, we're kind of it seems like kind of a waiting pattern. Are the markets going to take off? Are they going to recede? So it's kind of a waiting situation. Tomorrow I'll break out my charts and we'll take a look and see what the trend looks like right now and where things may be headed. So, all right, I got a couple articles I want to breeze through today. So the first one is How the 2020s Economy Could Resemble the 1980s, written by Neil Irwin. All right, so let's go ahead and dive in. I mean, most of us, I was alive in the 80s. I was a young person, so I really wasn't paying attention to what was going on in the economy at that time. So, this is kind of a little refresher on what was going on 40 years ago. It's easy to recall the 1980s as being a boom time for the United States economy, a time of gleaming excess that, among other things, powered Ronald Reagan to a landslide re-election in 1984. But the decade didn't start out quite so sunny, and understanding the history of how the economy went from bust to boom in the early 1980s offers a surprising model for optimism about how the U.S. economy could progress in the next couple of years. All it would take is for the Federal Reserve to pull off a delicate economic pivot that is the mirror image of the one it managed 4 decades ago. Now, high inflation and a seemingly never-ending pandemic are depressing Americans' attitudes about the economy. By contrast, in December 1981, when Reagan had been president for 11 months, just as President Joe Biden has now, conditions were by most measures substantially worse. The unemployment rate was 8.5% and would keep rising through 1982. Inflation was 8.9%, and indexes of consumer sentiments were abysmal. In an issue of Time magazine published this month 40 years ago, if you flip past the cover story that ranks the performance of Reagan's cabinet and an advertisement pitching a Smith Corona typewriter as a holiday gift for your child, you could just see how bad the vibes were. Gathering gloom for workers goes the headline, reporting that a spreading slump swells the long gray line of the unemployed. The article said joblessness was so high in Detroit that community leaders fear that they're sitting on a smoldering powder keg of urban unrest. If nothing else, the chronology is a reminder that conditions can change surprisingly quickly. By the time Reagan was reelected in 1984, the jobless rate was 7.2% and falling, and inflation was down to 4.2%. Some commentators have argued that Biden has the opportunity to be the inverse of Reagan politically. Much of this commentary, it should be noted, came before Senator Joe Manchin pulled his support from the president's signature Build Back Better bill. And there is, of course, no telling what the next 3 years will bring politically, regardless of what happens in the economy. But in terms of the economic backdrop, it's important to understand the why of the Reagan economic reversal. Those gloomy unemployment reports in Reagan's first 2 years were a consequence of aggressive tightening of monetary policy by Fed Chair Paul Volcker, who was aiming to end the high inflation of the 1970s. Over the course of the previous decade, high inflation had come to seem inevitable. This led labor unions and individual workers to demand higher pay raises and made businesses willing to pay more and charge more for their products. This had settled into a vicious cycle with deep social and political ramifications. Inflation wasn't just an economic problem, said Mike Conzel, director of macroeconomic analysis at the Roosevelt Institute. It gave people the impression of a social and political breakdown, that the system was not working. Kind of like right now. Weird. Volcker wanted to break that psychology. He did it with steep interest rate increases that, in the service of inflation control, brought the worst downturn in 5 decades. Let's see. Across the government, including the Reagan administration, there was a concerted focus on breaking inflation, even as the job market worsened. What I find startling about the downturn is that so few politicians are calling for federal job training or the extension of unemployment benefits, said Alan Greenspan, a former presidential advisor who would go on to succeed Volcker in the 1982 Time article. 5 years ago, politicians would have been stumbling all over themselves to demand anti-recession spending. By late 1981, there were signs it was starting to work. That same article, for example, noted that Teamsters, who had managed a 31.5 pay raise in 1979, promised to be reasonable in their next negotiations, and that employees at major airlines had agreed to a 10% wage reduction. With this progress against inflation, Volcker was ready to relent and begin lowering interest rates. This enabled a speedy recovery from the recession powered by the Reagan boom and a period in which both unemployment and inflation were steadily falling. As Fed Chair now, Jerome Powell has recently faced the opposite problem. For most of the 2010s, inflation was the lower of the Fed aims for, and the job market was persistently weak. And for the first 9 months or so of the pandemic, too low inflation and too few jobs appeared to be the predominant economic problem. Just 1 year ago, in December of 2020, bond market prices implied that inflation would remain below the Fed's 2% target for years to come, and the jobless rate was still 6.7%. Powell and the Fed organized their strategy of monetary policy around building the Fed's credibility that it would no longer allow a persistently too low inflation and too weak job market. A new flexible average inflation target strategy introduced in 2020 was built on allowing inflation to sometimes overshoot 2%. That in turn helps explain why the Fed has been slow to move toward tighter money this year, even as inflation soared and the job market quickly recovered. Only this month, after a year-over-year inflation reached a whopping 6.8%, did Powell undertake a clear shift towards tighter money. He signaled the Fed would speed up the end of its bond buying program and would begin raising interest rates in the first part of 2022. Just as Volcker was willing to allow a recession to take hold to break the high inflation cycle of the 1970s, Powell has until recently emphasized that an inflationary surge that started earlier this year would likely be temporary, and the urgency of achieving full employment was paramount. The Powell pivot to tighter money in 2021 is the equivalent of Volcker's 1981 move. By then, Volcker was ready to relent and, in effect, declare victory, cutting interest rates and setting the stage for the economy to recover. The signs that inflation pressures were shifting downward was sufficiently compelling that the psychology had broken. So we see, I'm not going to finish this, but we talked about this probably last week, where the Fed has talked about raising interest rates up into like the 2.5% range. We looked at a chart from the Fed last week that showed the interest rates were up in the teens, up to up near 20, to put a stop to the inflation of the 1970s. So I don't know if a 2% interest rate or Fed funds rate is going to really put a dent into the inflation. So now, if they continue to raise the interest rates above and beyond that target, to quell this, well then, prove me, I will have been proven wrong, but as of right now, I just don't see, what they're doing right now is really going to have much of an effect. All right. Next article has to do with the Fed also. What happens next with the Fed's $9 trillion balance sheet? This was written by Brian Chung. All right. Since the beginning of the pandemic, the nation's central bank has aggressively printed trillions of dollars to keep the U.S. economy afloat. Doing so has ballooned the Federal Reserve's balance sheet to nearly $9 trillion. Fed officials acknowledge the risk of rising risk posed by inflationary pressures and are now starting to think about whether or not they can move to shrink the central bank's holdings next year. I have no idea what a normal balance sheet looks like anymore, said Federal Reserve Governor Christopher Waller on December 17th. Since the depths of the pandemic, the Fed has been buying U.S. Treasuries and agency mortgage-backed securities in the open market. Those purchases, in a process often referred to as quantitative easing, serve as a signal to markets that the Fed is serious about its intention to keep financial conditions loose. In November, the Fed kicked off its process to slowing the pace of those purchases, which it had been running at a clip of about $120 billion per month. After a print on inflation showing that the fastest pace of price increases since 1982, the Fed moved on December 15th to more quickly draw down its purchases. When the Fed brings the quantitative easing program to a full stop around March, policymakers will then turn their eyes to raising interest rates and perhaps unwinding of its balance sheet. The Fed signaled the likelihood of 3 interest rate hikes next year, a more aggressive path than the Fed watchers had originally expected. In light of this slightly earlier timing of hikes and Powell's comment that differences with the economic situation last cycle could influence thinking about the balance sheet policy, wrote Goldman Sachs Economics in a note. Wall Street analysts are pulling forward their expectations for when the Fed would start quantitative tightening, the process of shrinking the balance sheet by allowing maturing securities to roll off, as opposed to reinvest in new securities. Deutsche Bank, which originally expected the Fed to start the balance sheet unwind in the third quarter of 2023, now expects that process to begin in the back half of next year. Goldman Sachs has originally forecast a start date in the first half of 2023, but now expects the quantitative tightening to begin in the fourth quarter of next year. So we will see if that's actually the case. So, if you look back, this chart up here, you can see the balance sheet, from the last crisis, how it rose up to around $4.5 trillion. And it wasn't until the end of 2017 where that actually started to unwind. So nearly an entire decade from the housing crisis back, in 2008 and 9. So we had about a year or two of unwinding the balance sheet. Looks like we got down to about 3.8 trillion. Then, all things went to hell last year and they just printed money out the wazoo. And now the balance sheet sits just under 9 trillion. So they basically doubled it in a year. So awesome. So, like I said, if they stay the course, tighten up, reduce their purchases, and then by sometime next year, actually start allowing these to either fall off or sell off the assets, then, if they stay true to their word, that's a good thing. But if the economy starts to falter, I would bet my shoe on the fact that they will reverse course and probably start printing more money. So if that happens, I'd say that the Republic is doomed at that point. All right. Last article here. This is, one of my grind my gears articles. It's titled Economic and Racial Inequalities are long haul issues for the Federal Reserve. Now, this is my example of woke, journalism here. And it's the same guy, Brian Chung, who wrote the last article. So, all right, let's see what sort of genius this is in this article here. The Federal Reserve says it can only do so much to address earnings and wealth disparities, but feels an obligation to at least research the economic implications of uneven economic outcomes in the United States. The Fed's own statistics confirm the divide. In its 2019 survey of consumer finances, white families were reported to have a median wealth level of $188,200, substantially larger than the median black family's wealth of $24,100. Growth rates in wealth holding for black and Hispanic families, 33 and 65% respectively, were faster than that of white families, 3% from 2016 to 2019. When we're not interacting with people, a lot of the time when we're interacting with people, a lot of the time we'll hear comments like it wasn't aware that the Federal Reserve was interested in these issues, said Dionysi Alaprantis, director of the Program of Economic Inclusion at the Federal Reserve Bank of Cleveland. The Cleveland Fed recently commissioned Cleveland-based artists Chris Webb and Paris Mackey for a video highlighting the reasons why the central bank is studying racial inequities in the U.S. economy. The video highlights economic issues that the program hopes to more deeply research, such as the ways in which discrimination in education, the labor market, housing, and access to credit further entrenches wealth and income gaps. These disparities stand still from the racism that is systemic. It can be traced from employment to small businesses and the wealth that still exists today in ways that still damage our country's health. Maximum employment. Spoken poetry and collage art are not often associated with the central bank, which relies on little art when communicating its economic policies. The Fed uses interest rates and other policy tools to steer inflation and labor market conditions. Even though Congress may be better suited to directly impact policies on education or housing, Alaprantis said that the Fed's mandate of maximum employment requires the central bank to at least pay mind to economic inequities. We're trying to make it clear that we see ourselves as being in it for the long haul, and we're committed to trying to understand and improve the situation. In other aspects, the Fed has a more direct responsibility in monitoring discrimination. As a primary banking regulator, the Community Reinvestment Act has required the Fed to ensure that a bank lends and invests in low and moderate income communities where it is present. The Cleveland Fed is one of 12 regional outposts for the Federal Reserve System, which is headquartered in Washington, D.C., blah, 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 blah. All right. So what a waste of resources, quite honestly. The fact that, certain demographics don't have the same wealth as others, I see that more as a failure of the local communities that do not, help out their constituents. So it's not a me problem or a you problem. It's a parent problem, quite honestly. When you don't have good families and you raise shitty kids and they don't grow up to have job skills or the ability to market themselves, that's not a me problem. And quite frankly, it's the education system doesn't even really help that much at all these days. So it's unfortunate, but, I don't think that it's really a place for the Federal Reserve or even the federal government. I mean, these are local problems that, unfortunately should be solved at the local level. And, while I feel for people who, live in a shitty environment, my advice to anyone raising kids in an environment that isn't safe and have, a good community is move. Get the hell out of those areas. That is the best advice possible. So, it's unfortunate, but, raising a family in the hood is probably not the best bet for success for your children long term. So anyways, all right. Well, that's everything I had for today. So like I said, I had just 2 articles and then 1 woke article that, keep your eye out for this stuff because this BS is, I can't even think of the word. So, all right. Well, that's everything I had for today. So if anyone needs anything from me, be sure to shoot me out an email or drop me a phone call. And I'll be back tomorrow with the Liberty Call for Wednesday. And everyone have a fantastic day. Bye-bye.